Successful crypto trading requires careful planning, strategy, and a deep understanding of market trends. While the cryptocurrency market is volatile and can be unpredictable, several proven trading strategies can increase your chances of success. Day trading involves making multiple trades within a single day to take advantage of small price fluctuations. Traders look for short-term opportunities and capitalize on the price swings within the daily market cycle. The key is to stay active and make quick decisions. Charts, technical indicators, such as RSI, MACD, Bollinger Bands, and real-time news feeds are crucial. Avoid holding positions overnight to reduce exposure to potential market movements while you're not active. Swing trading seeks to capture short to medium-term gains by identifying swings in the market. Traders typically hold assets for several days or weeks to take advantage of price moves within a medium-term trend. They use technical analysis to identify entry and exit points based on patterns or trends. Moving averages, candlestick patterns, and trend indicators. Market can reverse unexpectedly, so it's important to use stop-loss orders. Scalping is one of the fastest crypto trading strategies, focusing on small but frequent profits. Traders open multiple positions throughout the day and aim to make a small profit on each trade. Scalpers look for opportunities where the price fluctuates in very short time frames. High-frequency trading systems, charts, and order book analysis to track micro price movements. Traders need to react quickly, and trading fees can eat into profits. Due to the speed, it's essential to have a fast internet connection and be ready to act swiftly on trends. Hodling, hold on for dear life, involves buying and holding cryptocurrencies for the long term, often through market fluctuations. Investors believe in the long-term value of a specific cryptocurrency, like Bitcoin or Ethereum, and hold their assets through volatility. This strategy requires strong conviction and the ability to endure market downturns. Exposure to large market swings, but long-term holders generally ride out bear markets, anticipating growth over years. Diversify your portfolio to reduce risks and focus on high-potential coins with strong fundamentals. Trend-following strategy is based on identifying and following market trends, whether up or down. Traders buy in a rising market and sell in a falling market, based on technical indicators and chart patterns. It relies on the concept that prices tend to move in trends, and you want to capture that movement. Moving averages, MA, the average directional index, ADX, and trend lines. Trends can reverse abruptly, especially in volatile markets like crypto. Always set stop-loss orders to protect against sudden reversals and use trailing stops to lock in profits as trends continue. Arbitrage takes advantage of price differences for the same cryptocurrency on different exchanges. Traders buy cryptocurrency at a lower price on one exchange and sell it at a higher price on another exchange, profiting from the price difference. Automated trading bots, exchange rate comparison tools, and fast execution of orders. Transaction fees, slippage, and the speed required to capitalize on the price difference before it disappears. Automated bots can help you quickly identify and execute arbitrage opportunities, but be mindful of fees and withdrawal limits. Fundamental analysis, FA. This strategy involves analyzing the intrinsic value of cryptocurrencies based on various factors like technology, team, market demand, and competition. Traders and investors evaluate projects' white papers, the development team, adoption potential, and other fundamentals to identify undervalued coins. White papers, news, social media sentiment, partnerships, and the project's roadmap. While promising, the fundamental analysis is subjective and depends on the long-term success of a project. Diversify across multiple coins and stay updated on news that might affect the crypto market. Copy trading, or social trading, allows traders to mimic the trades of successful investors. Platforms allow you to automatically copy the trades of experienced traders, which can be a passive strategy for beginners. Trading platforms that support copy trading, such as eToro and Covesting. The success of this strategy depends on the performance of the trader you copy, and past performance is not always indicative of future results. Start by copying traders who have a proven, consistent track record, and understand the risks involved. Risk management is crucial in any trading strategy to protect capital and limit losses. Setting stop-loss orders is essential. Traders should only risk a small percentage of their capital on any single trade, commonly 1 to 2%, to avoid catastrophic losses. Stop loss and take profit orders, position sizing. Risk management doesn't guarantee success, but it helps mitigate the potential impact of loss. Stick to your risk tolerance, and don't let emotions drive your decisions. Use risk-reward ratios to ensure profitable trades in the long term. Leverage allows traders to amplify potential returns by borrowing capital to make larger trades. Traders use leverage to magnify their position sizes and increase profits from smaller price movements. However, losses can also be amplified, so caution is necessary. Margin accounts, leveraged trading platforms. High potential for large losses if the market moves against your position. Losses can exceed your initial investment. Leverage should only be used by experienced traders and always with risk management tools in place. In the world of crypto trading, having a clear strategy can make the difference between success and failure. One approach is to focus on market sentiment analysis, where traders monitor social media, forums, and news outlets to gauge the mood of investors. Positive sentiment can indicate an upward trend, while negative sentiment can signal impending corrections. By leveraging sentiment, traders can position themselves ahead of major market movements, capitalizing on collective psychological shifts that influence price action. Another approach is liquidity pool analysis. Liquidity pools in decentralized exchanges, DEXs, play a critical role in price stability. Traders can analyze the size and depth of these pools to predict price movements. If a pool is unusually small or its liquidity is highly concentrated, the price of an asset can be more volatile, presenting opportunities for traders to execute rapid trades before large price swings. In addition, blockchain analytics is becoming an increasingly important strategy. By tracking large transactions and wallet movements, traders can gain insights into market manipulation or large institutional investments. When big players move coins into exchanges or cold wallets, it can indicate accumulation or distribution, offering clues about future price trends. Blockchain explorers like Glassnode or Nansen provide data on on-chain activity that can be used to anticipate price actions based on real-time network behavior. For those willing to embrace more technical strategies, volatility-based trading can be effective. This strategy focuses on the periods of extreme price swings in the crypto market. By setting specific volatility thresholds, traders can enter the market during high volatility phases when the potential for profit is greater. The key to success with volatility-based strategies lies in timing entry and exit points accurately, often using tools like the average true range (ATR) indicator to measure market volatility. Event-driven trading is another less common strategy but one that can yield high returns. Traders who focus on significant events, such as network upgrades, like Ethereum's transition to proof of stake, regulatory announcements, or major partnerships, can position themselves ahead of these events. The anticipation of such events can cause prices to move sharply, and traders who recognize these moments early can profit from the price surge or decline that follows. Some traders have found success using mean reversion strategies, which assume that cryptocurrency prices tend to revert to a long-term average. For example, if a cryptocurrency moves significantly away from its average price, traders might expect it to return to that mean. This strategy relies heavily on understanding the fair value of a coin, and traders use technical indicators to spot overbought or oversold conditions, identifying opportune moments for entry. Finally, smart contract arbitrage offers a unique edge. As decentralized finance, DeFi, grows, it creates opportunities for arbitrage between different smart contract-based platforms. These trades exploit discrepancies between the prices of tokens on different DeFi platforms. By identifying pricing inefficiencies across multiple decentralized exchanges, traders can make profits by quickly moving assets between platforms to take advantage of price differences. Each of these strategies emphasizes a deep understanding of market dynamics and requires disciplined execution. The key to sustained success in crypto trading lies in the ability to adapt and innovate while managing risk and capital effectively.